Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at Everything You Need to Know in 90 seconds at 9 o'clock. With news, the Aussies are now seriously concerned about their debt-to-income relationships. But first, in the US, the employment gains keep coming, with the private sector payrolls rising by a healthy 263,000 in March, according to the precursor ADP Employment Report. This was much better than analysts were expecting, and markets are impressed today. Markets are now expecting Saturday's non-farm payroll report to outperform as well. Analysts had expected 177,000 gain, but they will no doubt be revising that forecast as we speak. However, it is not all roses. There were two indexes out overnight that measure the expansion of the giant US services sector, and both show the expansion slowing somewhat. And just as we publish, Wall Street has suddenly turned negative, maybe on some concerns that showed through in the Fed minutes that markets are getting ahead of themselves. These US Fed minutes were released a few minutes ago, and they confirmed they will begin shrinking their $4.5 trillion portfolio of Treasury and mortgage securities later this year, although they remain undecided on some important tactical questions, such as how quickly to reduce the holdings and to what level. In Australia, as banks turn themselves into mortgage banks, or what we used to know as building societies, their regulators decided to push ahead with tougher capital rules. Their goal is to make the bank's capital base unquestionably strong from a position now where it is not. APRA has grown frustrated with the endless delays out of Basel on the matter and has decided to push ahead on its own. Shareholders are going to have to take on much more risk, it seems, and borrowers may pay the price with harder access to loans and possibly higher interest rates. There is little doubt now that the new aggressive stance will flow through to New Zealand. In Australia, their household debt-to-income ratio is pushing 190% in RBA data released for December 31st. That compares with the New Zealand level of 168% and rising at only half the rate of the Aussies since the start of the GFC. In New York, the US Treasury 10-year yield tried to find its feet earlier, but is now slipping lower and is now at 2.33%. And our local 2-10 wholesale rate curve is now at its flattest level in 10 weeks. Oil prices are little changed at $51 for the US benchmark, while the Brent benchmark is now over $54.50 a barrel. The gold price is lower today, down $6 to $1,248 an ounce. And the New Zealand dollar starts today lower too, at 69.5 US cents. On the cross rate, the Kiwi dollar is down to 91.8 Aussie cents, and against the euro is at 65.3 euro cents. The TWI is at 74.7, and that is now its lowest level in almost 6 months. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.